I haven't talked about derivatives enough, and most of you probably don't even know what they are because they're so opaque and hidden. A derivative is a contract that bets on the price action of something else, and all it's done with lots of borrowed money is put you in more jeopardy. Nobody really has any kind of clue of the true value that's really at risk in here. So recently I did an interview with my good friend Rick Rule, and we ended up speaking mostly about derivatives, which quite honestly I loved because I do believe that a derivative implosion is what's going to ultimately overwhelm central banks' ability to, just kind of print our way out of a crisis. But I also realized that I haven't talked about derivatives enough, and most of you probably don't even know what they are because they're so opaque and hidden. And yet I reference them regularly through the Office of the Comptroller of the Currency. So today we're going to dig into derivatives, which I think is probably one of the single most important topics for you to understand. So you want to listen to the interview I did with Rick Rule, but now I want you to imagine that you are standing on a frozen lake. The ice looks solid. People are skating. Everything seems just fine. But underneath, the ice is deep, freezing water, and the ice is only strong if every single part of it holds together. Now, imagine someone starts jumping on one thin spot. If that spot cracks, the whole sheet can break, and everyone, everywhere on that ice will fall in. Well, I hate to say this, but quite honestly, that's our financial system. The ice are the banks. The deep water is the risk, and the cracks are interest rates, debt, and the derivatives that are attached to them. So what is a derivative? A derivative is a contract that bets on the price action of something else, just the price action. They can never convert it into that underlying. So it could be against stocks or bonds or credit or weather. Frankly, virtually anything. What am I going to wear today? But it does not own the underlying. And all it's done with lots of borrowed money is put you in more jeopardy. Sounds safe, right? I mean, the banks, after all, should know what they're doing. But if the ice is the system, that first crack we need to look at are the promises banks make to each other. Because that, my friends, is where the danger starts. And this is very opaque. You and I merely see the surface. We don't really see what's underneath. And because remember, we've talked about counterparty risk. So what is that? Well, counterparty credit risk is a significant risk in the bank derivative trading activity. Because if one player can't pay, everybody is in trouble. Because all derivatives they're promises between banks. And if one bank breaks a promise, the next bank gets hurt. And then the next and the next. It's like a domino. It's like a line of kids holding hands. If one falls, guess what? They all get pulled down. And when those promises get too big, the next question is, who's holding them? Because if the wrong player slips, the SIFIs, systemically important financial institutions, quite honestly, everybody feels it. This is critical for you to understand because there are basically 4 banks that hold almost everything. And oh, by the way, they also own almost everything. I want you to think of 4 kids holding almost all the marbles on the playground. If one drops their bag, marbles go everywhere and everyone gets caught in the mess. And it's hard to tell whose marbles were this, whose marbles were that. And when just a few giants hold almost all of the marbles, the derivative marbles, Well, you can bet they're not just holding them, they're playing with them. The reality is that banks depend on trading. And that's the way they make most of their money, is from trading, not from normal banking. So this is like a store that makes more money from lottery tickets than from selling the food itself. If the lottery stops, the store is in trouble. And once the game becomes the main way they make money, the size of those bets start to matter a whole lot more. And when you look on the balance sheet of these banks, and who are we talking about? We're talking about the big ones. They hold the lion's share of the derivatives, but look at the level of your deposits, the equity that I have. Frankly, it is dwarfed by the amount of bets that they have on top of it. And that turns it into a big fat casino where 98.4% of all notional, and we're going to get into that in just a second, where all notional amounts of derivative contracts are held for trading, 98.4%. Well, that was the problem that happened prior to 2008. And then the Dodd-Frank Act, enacted in 2010, we're supposed to take care of that so that banks stop doing proprietary trading. I don't know, you guys. This is the most current version from the Office of the Comptroller of the Currency. Does it look like they have stopped that to you? Because the answer would be no. It's how they make most of their money. Let me show you. Because this is a bank trading revenue as a percent of holding company trading revenue. And imagine a snowball running downhill. Every single year, it gets bigger and bigger and bigger. And so this is true from 2008. I'm going to show you that in a minute. But now it's so big that, quite honestly, it could flatten a house. It could flatten an entire economy. That, my friends, it's what's actually happening with derivatives. But instead of slowing down that snowball since 2010, all of this talk about deregulation, the snowball just keeps growing. And the system tries to make it look smaller with very clever tricks. Not so clever at the end of the day. But let me show you what I'm talking about. Because somehow with banks' formulations, well, this netting trick makes risks look even smaller. But hey, the banks say, don't worry, we can cancel out most of the risk. Hold on a second, because I'm going to show this to you. What you're looking at right now are the level of derivatives in the third quarter of 2025 that are held by the largest FDIC insured banks. So let's establish this level first, because as you can see, we are much higher in trading derivatives today than we were when the crisis hit in 2008. Are they safer? No, they're just more hidden. And even though you're looking that it's higher, wait, let me show you something that really should worry you, because I know it worries me. And as we know, because I've talked about it a gazillion times, when things don't look like they want it to look, what they do is they change the formula. So this is netting, which really was changed. The way they did it was changed in 2013 to make it look smaller. But a netting benefit is the amount of gross credit exposure. Okay, we have taken on all of this risk, and it's eliminated through bilateral, two parties, bilateral netting in those FDIC banks. And let me show you what that looks like, because that's the level of the netting that was done in 2008. And today, a full 88.4% of all trades are netted out. You probably don't even know what that means or why that matters. But look at the level, the difference between 2008 and today, what I'm really showing you here is that it's a way to hide the truth and hide the risk that you're taking. So it's kind of like saying, okay, I owe you $10, you owe me $8. So in reality, I really only owe you $2. The rest of that money is not at risk, but it's between two entities, it's bilateral, and that's it. It only works if everyone pays. But if someone can't pay, like AIG in 2008, the entire thing falls apart. And that trick, netting, well, that's only the first magic act. The next one shrinks the balance sheet even more, at least on paper, not in reality. And this is the clearing adjustments that they also run through the wash. The system uses these tricks to make huge numbers look tiny and hide the risk that really you and I are facing. It's like taking a giant pile of homework and saying, well, if I ignore this page and skip that page and pretend this page doesn't count, well, I only have one page left to do. Woohoo! But quite honestly, the pile of papers and the work that you were supposed to do, they're still there. But before we go any further, we need to clear up one of the biggest myths in the whole system. And that is the idea that notional doesn't matter. So let me show you how they can take $435 billion or $1 trillion worth of contracts, derivative contracts, and look at that. They run it through all of these complex formulas, and magically, that 435 trillion turns into 9 trillion. That's the number that you and I see. But that 435, guess what? It's still in there. And these formulas are so complex that nobody, and they all admit it, the IMF, the BIS, all of them, nobody really has any kind of clue of the true value that's really at risk in here. I'm going to try and define that more for you as we go through this. But again, notional risk, as you see, higher than 2008. Well, that determines how big the payments are, not what's really at risk. Banks can say notional is the real risk, and no, it is not. I just showed you how they converted 435 of them into 9. But the notional is merely the agreed to contract amount, and with admitted 88.4% contract elimination. Let me repeat this. No one, and I mean no one, knows the real value that's at risk. And I cannot stress that enough. And when things go wrong, you remember 2008, it's like saying the height of a roller coaster doesn't matter until you go down the drop. And if you don't have your seatbelt on, meaning gold and silver, that drop could kill you. So we've already seen how we can convert $435 billion or $1 trillion worth of derivatives and end up with 9. So how big are the derivatives in the system? Well, look, you need to understand this is a guesstimate based upon their data. But again, this is the third quarter 2025, and you can see that those trading derivatives are at nosebleed level, almost 100%, not quite, but pretty darn close. So what they're saying at the moment, or at least as of the third quarter in 2025, that there were 225 in notional value, in trading value. That's just contracts. That's the cost and the price of those contracts. So how big do you think the derivative bet book, because that's what it is, a big bet, how big do you think that could possibly be? Well, that, presuming, this all came out of the same report. So what we're looking at here, the Office of the Comptroller of the Currency said that 88.4% of the derivatives were netted out. That was the netting benefit. That means that 225 trillion in derivatives represents 11.6% of the derivatives that have been netted out, right? So what is that number? Because I just about fell off my chair when I did that calculation. That would tell us, presuming nothing else is hidden, which that's probably not true either, and this is just the FDIC insured banks, where you have your deposits, they're showing that with that netting benefit, there's 1.939 quadrillion. Can you even begin to wrap your brain around that number? But really, the truth is, nobody actually knows what the value at risk is. And by the way, that 1.939 quadrillion, that's just the value of the contracts, the original amount of the contracts before netting to get us to 225 trillion. I'm giving you a second to take that in, because that means that those bets that are floating out there that killed the system in 2008, how do you even begin to bail something like that out? How many quadrillions? And when you make a comparison in the level of derivatives to the GDP, it's a joke. It's a joke. Can you see how that could completely break the entire system, that it could not be bailed out? So what you're looking at here are derivatives on precious metals, which is primarily gold, in the FDIC insured bank. And what they're admitting to for just this quarter 2025, there's 700 billion in notional value. How much there is, who knows? But you can see that surge. For 20 years, this chart was pretty calm. And then boom, it shot up like a rocket. What do you think? Short-term bets, fast-moving bets, big bets, or they were forced to change a little bit of the accounting? But what this tells you, even if you think what you're looking at is real and the truth, this tells us that the pressure is building, because that spike in precious metals bets is just one corner of the story. And when you zoom out, well, look, this picture says it all. The real assets, the buildings, I mean, look at them. There's the little White House. They're teeny tiny. But the derivative, the walls, they're enormous. And we can't even really see how high they go. It's like having a tiny tree holding up a giant elephant. Well, the elephant doesn't notice until the tree snaps. And when you see how huge that elephant is, the next question is simple. How strong is the tree holding that up? No one knows. No one knows the true level of leverage. It's just a reference amount that determines contractual payments, but it's not the amount at risk. No one knows the true level of leverage. That's debt upon equity, like debt. That's what leverage is. No one knows the true amount at risk, and no one knows what that final trigger is going to be. And so when you see how huge that elephant is, the next question is simple. No one knows the final trigger. And so you sit there and you say, yes, my deposits are safe. They're insured.
It's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be.
People need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
The insurance fund is teeny tiny compared to the deposits, because the FDIC, well, frankly, look at this. Here it is. This is the DIF fund. I recently did a report on this. You can go back and go into it. But if you look at the insured deposits over 10, almost 11 trillion, But what do they have in reserve? 150 billion. So that's like having 150 in your wallet while promising to cover $10,700 worth of bills. It's not enough. And it's definitely not enough for a derivatives problem like I just showed you. So when you see the FDIC fund, that DIF fund, 150 trying to cover 10,700, you realize that the real issue isn't just the size of the backstop, it's the system that we have built on top of it. Every single year, the products get easier to create. They get cheaper to trade. They get more complex to understand and far more dangerous when they crack. Derivatives, synthetics, digital assets, they're all stacked on the same thin ice and getting bigger and more vulnerable and more overvalued. And frankly, that brings us to the real picture. Now imagine that same frozen lake, but this time you're not standing still. You're on a school bus driving right across it. And that's today's market. Bitcoin is sliding around on the surface, acting like a trade that requires confidence instead of a hedge based upon broad required demand. I cannot say this enough. I never will say this enough. This is my physical representation of Bitcoin. It was designed to look like this 1 ounce of gold so that you would think that this is digital gold. It's not. And now what is it doing? It's sliding around on the surface because it's used in one place. But gold? It's anchored into 33 real-world sectors: electronics, aerospace, medicine, food, defense, energy, satellites, AI, EVs, just to mention a few of them. Bitcoin has one use case: speculation. So when the ice gets thin, gold's use case in 33 sectors of the global economy, well, that supports constant demand. A 5,000-year proven track record and a fact. And Bitcoin, born January 2009, it just has to sit there and wait for buyers. And of course, we do know that banks and governments are rushing to adopt this technology, even as retail investors are going, no, doesn't matter. It's going to be shoved down our throats. Plus, the bus is picking up speed. So what do? You don't panic. You don't scream. You prepare. You get your life preservers on. You pay attention. You get ready for those bumps because you know the ice isn't as strong as it looks. That's what physical gold and silver are. They're your life preserver on this frozen lake in this bus that you can't stop. They don't stop the cracks. They don't even change the weather, but they protect you when the system hits the weak spots. Don't wait for the bus to hit the thin spot. Get your life preservers on now. Protect what you've built. Give yourself something real, something that doesn't melt when the system gets warm, something that protects you, your life preserver. Together, I know we can do this. But you got to understand derivatives, although I don't know anybody else that really does, to be honest with you. It's not what you can see that is the scariest. It's what you don't see. But here, my friends, here is your life preserver, along with food, water, energy, security, barterability, wealth preservation, community, and shelter. And until next we meet, please be safe out there. Bye-bye.